Aggregate demand curve, the price level and the real output is labeled. Vertical axis always labeled as price level. Horizontal axis should be labeled as real output or else GDP. Sometimes Y or else income. Different terms can be seen. Whatever the term mentioned here, it represents similar idea of country's GDP or else output. Later on, we will identify what is the meaning of GDP. One price level and the real GDP or output is inversely related. That is the shape of aggregate demand curve. Actually, here it is not a straight line, but you can draw a straight line even. It is not a problem. So aggregate demand and the price level is inversely related. That means when average price level increases, output falls. When the price level falls, output increases. And one more thing. In microeconomics, we just wrote price. In macroeconomics, you must write price level. It is compulsory. Price level means average price of all the goods. Therefore, you should write price level. And there is an inverse relationship, as I told you. A movement occurs along the aggregate demand curve. Even there are shifts along the aggregate demand curve. Here, price level. Price level increases to P2. If so, output Y1 decreases to Y2. So these changes can be seen. In other words, movement along the curve. This is upward movement as well as downward movement can also be seen when there is a reduction in the average price level. So there are some reasons. There are some reasons behind such a movement. Here, there are several explanations for an inverse relationship between aggregate demand and the price level in the economy. There are three. Fall in real income, if not we can say real income effect. Real income effect. So average price level increased. Average price level increased. When the price level increases, necessarily people's real income goes down. People's real income goes down. Here, such a situation. Right. Price level. Real GDP. If the price level increases, people have lower real income. Means now they purchase less number of goods. There is a movement up along the aggregate demand curve. So it is known as income effect, real income effect. I did write opposite. It is also the same. When the price level falls, real income increases. As a result, a movement downward along the curve. Therefore, aggregate demand curve slopes downward from left to right. So it says as the price level rises, the real income, real value of people's income fall, and consumers are less able to buy items they want or need. As well as when income, say, when price level decreases, people will have a higher real income, and therefore people tend to buy many goods. Actually, it represents the extension in aggregate demand. Extension in aggregate demand. So movement downward. In this case, by less, it is contraction in aggregate demand. So extension and contraction occurs. Therefore, aggregate demand curve slopes downward. It is first point. Next one, international trade effect. What does international trade effect represents? A persistent rising price level countries would make foreign goods are cheaper. Cheaper terms cause in fall in export, rise in imports. Actually, when the price level increases, our products are less competitive. Our products are less competitive. As a result, foreigners, non-residents purchase less. Non-residents purchase less, then the aggregate demand falls. As well as price level goes down, our goods are really cheaper to abroad, then they buy many units, then aggregate demand increases. Once again, price level and the aggregate demand is inversely related. Next one, interest rate effect. Interest rate effect represent the changes in rate of interest. If the bank offer a higher rate of interest, we tend to save more. That is the normal scenario. If there is a high price level, bank may also introduce a higher rate of interest. Then people tend to save instead of allocating money for the consumption. So aggregate demand falls. On the other hand, when the price level goes down, interest rate also falls. Then people do not save. They will use money for the consumption of goods and services. Once again, aggregate demand will rise. As a result, aggregate demand and the price level is inversely related. So these are the three reasons. That's why a movement occurs along the aggregate demand curve. So there is a question. It says that the diagram shows an aggregate demand curve. X and Y is labeled. Y, of course, vertical axis. I told you necessarily this should be labeled as price level, but horizontal axis should be labeled as real GDP compulsorily. Therefore, a horizontal axis X real GDP, vertical axis price level. That's how we should label aggregate demand diagram. There is another question. What does an aggregate demand curve show? Actually, aggregate demand curve represent total demand for goods and services which are demanded by all the people at different price level. So here, the level of aggregate demand corresponding different level of aggregate supply. Next, the aggregate output demanded corresponding to different average price levels. The equilibrium price level corresponding to different levels of aggregate expenditure. The equilibrium level of income corresponding to different levels of aggregate expenditure. In here, our answer is B, because aggregate output demanded corresponding to different average price levels. That is the sort of definition we identified regarding aggregate demand. Once again, the diagram shows an aggregate demand curve. So the aggregate demand the diagram shows an aggregate demand curve. What helps to explain why curve is downward sloping? Actually, curve is downward sloping. We knew that because of three reasons: income effect, international trade effect, and interest rate effect. When export increases, there will be an increase in national income. When government expenditure increases, there will be an increase in national output. When investment increases, there will be an increase in consumption. Price level increases, there will be an increase in interest rate. So our answer is last one. Price level and the interest rate is considered under interest rate effect. So answer is D here. Meanwhile, we do concentrate different models of economic systems. Different models of economic systems. Actually, there are no real. These are actually not the economic system. These are not like economic system what we studied, like market economic command. Not like this. This is a particular model just we want to build for the purpose of analyzing theory. Anyways, every country or every economy consists of these four participants: household, firms, government, foreign sector. As well as it is a closed economy or two-sector economy, only household and firms exist. In practice, there are no any country like that. It's only a model, and purpose is analyzing the theory. Three-sector economy, these three: households, firms, government, concentrate all these. Even there are no countries in the world when we look at command economy. It's very rare even nowadays. Anyways, it's a model, but open economy, of course, it is there in every country. Households, firms, government, foreign sector. If all these are involved in transactions, then we can say as an open economy. Anyways, closed economy, three-sector economy, open economy. You are given a table over here. This is a particular method of analyzing countries' aggregate demand and countries' national output. Countries' national output. You know, country has every country consists of these four sectors. Then households purchase goods, it is called consumption. Firms spend money, called investment. Government purchase goods, known as government spending. Foreign sector even spend, it is called net export. Likewise, this is how we realize components of aggregate demand. So what does first row after this represent way of analyzing national output? National output, we can write in simple term the way of calculating countries' GDP. The way of calculating countries' GDP. Here one method, Y equal E. Y means yield. Equal E. E means expenditure. For example, when we purchase goods, households, firms, government, foreign sector, it is a demand as well as total expenditure. Aggregate demand is C plus I plus G plus X minus M. Also, this is the total expenditure. You can remember under microeconomics, there is a producer's revenue as well as consumer's expenditure. Producer's revenue equivalent to consumer's expenditure. As usual, demand means, on the other hand, total expenditure. Even expenditure is the same, CIG X minus M. Right. Therefore, E means aggregate expenditure. In here, E means aggregate expenditure. So what are the components? In the closed economy, only C and I. Why? Household and firms. In the three-sector economy, C, I, G. In open economy, everything. And one more is given as a last row here. It is called W equal J. W equal J. W means withdrawals. J means injections. When there is a output, when we purchase goods, for example, you earn money, 100,000 for the month. Assume like that. Even though you earn 100,000, your total expenditure on goods and services is not 100,000. Why? you should definitely save a particular amount for the future purpose. That's how every person behave, like rational behavior. So then we will imagine 20,000 is kept for the future. If you save in such a way, that amount cannot be used to purchase goods and services. It is called saving as well as withdrawal. Withdrawal means such an amount now gone, simply not used to buy goods and services. Saving is a withdrawal in the closed economy. Injection, J. I, investment is a injection in a closed economy. Why is that? We save money. Actually, we save money in a bank or financial institutions. So these financial institutions lend money to businesses or investors. What is the purpose? To earn particular profit for the business bank, whereas investors get our money. They receive our money, what we saved, and they use. Simply, once again, what we saved goes to the economy in form of investment, right? So saving is exactly equal to investment, because investors use our money to invest. So here we assume saving sense not at home, under a formal banking sector. Investment depends on savings, so they borrowed and invested. So saving is exactly equal to I. When the national income, I mean the GDP, when there is a national income sense equilibrium. Why is that? When there is a total GDP, such total GDP, this is the Y, income. Income means GDP. So GDP now equal to, or the income is equal to expenditure. The total income is equivalent to expenditure. That such a position is called equilibrium. As same as demand supply theory in microeconomics. Number of goods are traded, number of units of a good is traded between buyers and sellers at the equilibrium price. Likewise, in here, total output is purchased. If so, national equilibrium will take place. At the same time, you may have a doubt whether all the output that the economy produced will be purchased by sectors in the economy, like participants. Actually, it is not always. In some cases, total output produced by the economy cannot be sold. Simply, stocks are remaining. Sometimes more than that. It is called, both situations are called national disequilibrium. So we do concentrate equilibrium. Equilibrium means a particular place where total output equal to total expenditure. So three sector economy, in addition G, as well as under withdrawal equal injection method. Tax is a withdrawal. If you earn 100,000, before spending 100,000, you are supposed to pay a tax. It is a withdrawal because you can't use such an amount now to buy goods and services. Meanwhile, government use such tax to spend. Same tax once again spent. So it is called government spending. So tax even equal to government expenditure. Next, open economy. CIG X minus M. X minus M, necessarily we should adjust net exports. So net exports represent clearly the total output that the economy produced. If we add such an amount to the CIG. So income, this is the total components of aggregate demand. So it is equivalent to GDP. Then the next, imports. We have to buy goods from other countries. We have to buy goods from other countries. Then what do we have to spend? Dollars. So we spend dollars equivalent to the amount what we earn through export. What we earn through export. When we export goods, we have received dollars. Such dollars now spent. Even it is equal. We can import only the quantity of goods or quantity of, we can say, level of income we earn through exports. Therefore, the left side of the equation is exactly equal to the right side of the equation. And there is a direct relationship between each and every component. For example, saving and investment. Saved money can only be invested, therefore equal. Even tax revenue when government is spending, taxed revenue can only be spent by the government, not more than that. Next one, exported income can only be used to buy goods from imports, equal. So that's why these formulas, these methods are used to calculate, apply for the calculation of countries' national equilibrium. In other words, a particular output where the total demand exists. So the economy should produce number of goods, then total demand even equal. If the economy produces less than that, there would be a problem. Demand is more than the production. Then people may suffer. Sometimes production is higher than the demand. Even people will have lot more than they need. So economy should realize a particular place where, particular output where they should produce. It should equal to aggregate demand. That is the meaning of these things. So next one, I added further explanation of injections withdrawal method. Injection into circular flow of income. Spending that puts money into the circular flow. So as I told you, investment, government is spending, exports. Even withdrawals are money take out from the circular flow. You may have a word called circular flow. Circular flow is a a particular analysis of realizing interrelationship between components or between participants we identified before. I mean, households, firms, government, and foreign sector. If we make such a format about interrelationship between each and every participant, it is called circular flow of income. Right now, you don't need to know this, but you should realize what are the things coming into the circular flow or to the entire economy. What are the things going out from the economy? Coming in, of course, investment, government spending, exports, like form of money, as well as financial flows out from the economy, saving, taxes, and imports. After that, we will learn rightward shift of AD curve. So, very beginning, we understood a left, say, movements along the aggregate demand curve, movements along the aggregate demand curve. Right now, we do concentrate rightward shift. Not only rightward shift, we have to know leftward shift as well. Rightward shift means increase in aggregate demand. Whenever components included in aggregate demand increases, what are the components? Once again, aggregate demand equals C plus I plus G plus X minus N. If any component of the aggregate demand decreases, definitely AD curve shifts, increases, AD curve shifts to the right. For example, consumption, it is called C. If consumption increases, it is in the right side of this equation. Necessarily left side will also increase. That is the situation. Whenever investment increases, it is in right side. As usual, aggregate demand in this formula will also increase. Government spending increased, while other factors same. Doesn't matter. Still aggregate demand rises. X minus N, net exports. This is actually called net exports. X minus N, net exports. So when net export increases, then economy will have a high aggregate demand. So sometimes there are questions whether it is necessarily required to increase all the components of aggregate demand to increase aggregate demand. Actually, do not need all the components. Even though one component increases, aggregate demand will rise. Sometimes we will realize in the practice, fluctuations. What are the fluctuations? C increases, I fell. Government spending increased, even export increased. Different fluctuations. Then how do we realize the impact on aggregate demand? It is impossible. Therefore, economists believe that when we concentrate a change in one component, other components are held constant. Then we know very well aggregate demand rises. When one component decreases, we assume that all other components are held constant. So then we surely know aggregate demand falls. This is sort of assumption. Then each and every case we consider as independent case, no any connection with each other. I added some examples over here. Reasons why consumption rises. Increase in consumer wealth, like better housing, value of shares, increase in income. Wealth means not the income, actually. Wealth means the assets, what they have. High houses, maybe vehicles, shares. If they have such a higher value, later on they can sell those and they can collect more income to spend. Then necessarily rightward shift of the aggregate demand curve. Sometimes lower rate of interest, special credit cards, or else any loan, personal loan, mortgages, whatever. If so, people will borrow and spend, higher consumption. Then higher wages, so income. If people have better wage, they spend a lot, increase in consumption. Lower taxes. Lower taxes mean taxes on, we can say, people's income, not like goods or services. This is about taxes on income, direct tax. If such a tax goes down, definitely people have better income to spend more, consumption rises. Increased consumer confidence. They believe that they have no fear of losing jobs. They believe they are having a good prospect. No economical bad impact in future, then they will definitely spend more. If they believe economy is not performing well, even they have no trust about future earnings, definitely they save a lot, spending goes down. Likewise. And the next one, increased investment. As a second point, here I added some examples. These are examples. There are more than this. These are only examples. Low rate of interest. So low rate, of course, investors believe they have cheaper cheap borrowing costing. They will spend lot. Even increase confidence in the economic outlook. As a result, the economy's investment will rise. Improved technology. Whenever the technology improved, they will try to invest more and more. Increase economic growth. People believe that, investors believe that economy is performing well. When the economy is having a stable background, no war, no political instability, as well as there is a economic stability. If so, definitely investors are encouraged. So economy will have a greater investment level. Next one, increase government spending. Government spend money for variety. So government can spend money. Actually, fiscal policy, you will learn this term later. Government spending is formulated, in other words, planned by a fiscal policy, simply government's budget. Fiscal policy is the technical term. Budget is a common word we come across. So expansion means very high government spending than tax revenue. So it is perceives expansionary fiscal policy means higher spending than tax revenue. This is the meaning of expansionary fiscal policy. Then government invest in infrastructure, like not only infrastructure, investing in many areas. In infrastructure is somewhat common. So maybe it's spending on roads, maybe telecommunication, and some other expenses. Next one, increased exports. What does exports represent here? Government economy collect more money from abroad by selling our goods. Whenever export increases, aggregate demand can increase. At the same time, decrease imports, then only aggregate demand will rise. You know, exported goods are produced within the country, but not purchased. There is no demand for exported goods, demanded by foreigners, but imported goods purchased by residents of the country, but not produced within the country. So we do deduct such imports from exported goods to calculate net exports. Then it represents actual quantity that the economy has produced. So here, UK more competitive, for example, increase in labor productivity would make more UK more competitive. Simply, export increases due to competition and labor productivity. Increase growth in other countries, then higher demand. Nowadays, other countries are having a recession, then we can't export much. What is the reason? Our goods are having lower demand. Then countries' export is low. In some cases, the countries are performing well in abroad. You see, as a result, we can export a lot, then increase export. Then low sterling means exchange rate. What does sterling represent here? Exchange rate, common term. We will learn all. If the exchange rate low, that means depreciation. Exchange rate depreciation. If the exchange rate depreciates, you know, exported goods are cheaper. So then many goods can be exported. Then country will have a better export revenue. Sometimes we can add quality as one reason, or else cheap products in the country, in other words, low inflation in the economy. Then we can export a lot to other countries. All of these are some examples, but I added only 3. Next, decrease imports. The way of reducing imports. UK more competitive. This makes goods from other countries cheaper appear less competitive. When we look at if the country like UK performing well, they do not need to import goods from other countries because country produces quality products than other countries. For example, if UK produces cars than Japan, I mean quality, then no need to import. Then UK imports decreases. Lower value of sterling as same. As a result, imports are expensive. Imports are really expensive. Whenever when the import expensive, demand for imports fall. That's the reason. Then decrease in imports. Lower GDP, therefore consumers will have less money to spend on imports actually. Here, economy was performing not well, like recessionary period. Then people have no money to spend. Then country will have a lower imports. These are reasons of rightward shift. Thereafter, we have to understand reasons for leftward shift. Leftward shift. So, rightward and leftward shift are the same. For example, I just write rightward shift of AB as well as leftward shift of AD. The things we understood here, increase in consumption, then increase in investment, as well as increase in government spending, and net exports. Increase in net exports. These are the four. Then we understood reasons, like examples under each and everything. Leftward shift, completely opposite. Decrease in consumption, as well as decrease in government, say investment. So decrease in government spending, as well as decrease in net exports. These are the reasons of rightward shift and leftward shift. So in the leftward shift, the same, we can say opposite. Same, what we mentioned before, can be represented opposite way. As well as I added some other reasons too. Many unexpected events cause changes in the level of aggregate demand, output, and employment. These events are called shocks. Some of aggregate causes of aggregate shocks are as follows. A large rise in exchange rate means appreciation. Earlier you observed depreciation, of course, increases export, reduces imports. Now appreciation means of the exchange rate, our country's currency are expensive, then we actually can export less, but we will import a lot. As a result, country's net export falls. Next one, recession. In main, trading partners affecting demand. So if there is a huge matter, recessionary time in other countries, so countries' aggregate demand decreases. Next one, slump in housing market, means wealth of consumers will slow down. If consumers have a really low wealth, they will spend less on consumption. Next one, events such as credit crunch. This is a problem came up in 2008 in the world with a global financial crisis. Bankers are now reluctant to lend. They think not to lend money. Typically, bankers lend money as much as possible, but banker believes borrower is not having a wealth to pay back. If they can't pay back, of course, credit crunch, I mean, banker will have a huge loss. especially this is regarding households and businesses. Bank may refuse. As a result, businesses and household are unable to get loans, then problem will rise. Next one, unexpected rise in interest rate. Of course, interest rate means people try to save a lot instead of consumption. If so, aggregate demand falls. Next one, investors are discouraged at a high rate of interest. Why? Cost of borrowing is high. Next one, government taxation would be a matter. If the taxation is high, both investors and consumers are discouraged. They have a low disposable income. Simply, disposable income means the income after direct tax. It goes down because they are supposed to pay more taxes, right? Therefore, countries' aggregate demand curve can shift to the left. These are what we studied now, reasons or examples. Aggregate demand curve may shift to the right or left in such a way. The diagram shows a shift in the aggregate demand curve of an economy from AD1 to AD2. What could have caused this shift? Of course, a rightward shift means increasing aggregate demand. Increasing aggregate demand. So, first one says an increase in expenditure on imports. No. Then what will happen? Aggregate demand decreases. Increase in tax rate. Even no. Countries' aggregate demand decreases because people, households and firms are supposed to pay higher tax. Increase in international trade deficit. What does trade deficit means? We will learn these words later. Right now, trade deficit means exports are lower than imports. Then what will happen? Imports are greater means necessarily a leftward shift, not a rightward shift. Then the last one says increasing money supply. Whenever money supply increases, people have a better income to buy goods and services. Better income to buy goods and services. Not only people, households. Firms even do the same, right? They spend more money to invest. As a result, aggregate demand increases. What will happen here? Increase in consumption. And investment. Right. So the next one. It's about leftward shift. Aggregate demand curve for an economy. What could cause economy's aggregate demand to shift from AD1 to AD2? Consumers spend more. No, it is actually reduced. Interest rate rise. No, actually, yes, interest rate rise means people now save more. Consumption goes down. Interest rate high means borrowing is expensive. Investment goes down. More output is spent, more output is sent abroad as export. No, it's impossible. If exports is high, aggregate demand shift to the right. Government switches expenditure from road to hospital. Whatever the change is still government expenditure, means increase in aggregate demand. So the answer here, B, interest rate rise, then only leftward shift of the aggregate demand curve. So this interest rate does not mean the interest rate what we discussed under interest rate effect. Actually, in that case, price level and the interest rate was having a particular relationship. Then only a movement occurred. Right now, no changes in price level, interest rate change. That's why curve can shift. Curve can shift to the right or else left. Right after aggregate demand, then we will look at the next component called aggregate supply. In here, aggregate supply is the total volume or total supply of goods and services. But aggregate supply in two types. Aggregate supply in two types. Short run and long run. Short run and long run are particular periods that we should realize. In the short run, of course, the production exists by using available resources. But in the long run, economy has reached its full capacity. All the resources are fully used. Therefore, aggregate supply should be analyzed in two ways: short run and long run. Right. First of all, aggregate supply measures the volume of goods and services produced each year. Aggregate supply can be split into two periods: short run and long run. Short run aggregate supply shows total planned output when price can change, whereas prices and productivity of factor input are assumed to be held constant. So in the short run, there are no changes in the productivity. Even prices of factor inputs are held constant, especially wages. Factor cost, we can say wages, and productivity are assumed to be held constant. If so, number of resources are used to produce a particular output into the country. So it says in the short, it says wages and wage rate and the state technology are held constant. In the short run, the SRA's short run aggregate supply curve is assumed to be upward sloping. It is responsive to change in aggregate demand in the change in general price level. Whenever the aggregate demand changes, average price level can also be changed. As a result, aggregate supply can also be aggregate supply can respond. Aggregate supply can respond. That's the meaning. We do learn later what kind of responses are there. Then long run aggregate supply shows planned output when both price and average wage rate can change. It is measure of country's potential output and the concept linked to the production possibility frontier where the curve shifts outward. So long run is a particular period. It concentrates productive potential. All the resources are fully employed for the production of goods, as well as it concentrates a production possibility curve when the economy operates on productively if the economy reach its fully capacity, of course, economy operates on the PPC. If the capacity increases, curve can shift to the right. Next one, in the long run, LRA's curve assumed to be vertical. It does not change when the price level changes. It is, fixed. Output is fixed. So we can say it is a full employment level of output. It is a full employment level. Employment level of output. Next one, short run aggregate supply curve. We do start separately. Short run aggregate supply. In the short run, there is a possibility to increase its output. For example, this is the aggregate demand curve. What did I draw? AD1. If the aggregate demand changes in such a way, here the output, here the output. Simply GDP increased. That's what earlier it said. There is a response of the output due to the increase in price level, due to the change in price level. When the price increases in such a way, your origin is 0, output will also increase. Why is that? Producers are encouraged to supply more. Producers are encouraged to supply more. Short-run supply curve slopes upward from left to right. This is a somewhat curved diagram, but we can draw a straight line even. So it says that as the general price level rises, the aggregate supply also rises and vice versa. Thus, short-run aggregate supply curve slopes upward. Movement can be seen along aggregate supply curve due to the change in price level. So what do we notice here? When aggregate demand increases, there is an increasing, or we can say expansion of aggregate supply, and therefore real output increases. Y1 to Y2. It is in the other way around is the same. When there is a decrease, when aggregate demand decreases, there is a contraction of aggregate supply, and therefore real output decreases from Y2 to Y1. This is how we notice the change in aggregate supply due to the change in aggregate demand.